Really, if we think about it, we can look at the history of banking in three mega eras, each defined by who built the moat and what inconvenience the customers had to tolerate at the time. So, if I start off with the first era, that's about 3,000 years from the age of Antiquity to about 1600s. The moat was purely geographic and physical, or what we would like to call the moat of access. It was built by essentially sovereign and religious authorities and also dynastic families. The inconvenience was the sheer physical effort of reaching them. For millennia, you traveled to the trusted physical source. It was like a pilgrimage to the Mesopotamian temple vaults to store your grain, or the hazardous journey during the Qing dynasty across China to use sophisticated cloud draft banks for remittance. You went to the Medici Bank in Florence, not because it was easy, but because the dynasty held the only legal and safe network to move funds across Europe. The barrier, Zubin, was access. And that was the ultimate gatekeeping strategy.
And let's shift then to sort of era two, which was about 300 years between the early 1600s up until probably 1970s, around till when we were born. And that moat was built by the state industrial bureaucracy and the specialized legal systems, or what we've called the moat of proprietary complexity. The inconvenience was no longer just the trip, but the frustration of bureaucracy and time. Banking became slow and complicated by design. Now, after the 17th century, state bank systems like the Bank of England were chartered to stabilize currencies. In the late 19th century, US JP Morgan became the private financier of industry. Post-Depression, the system really locked down under Glass-Steagall, making banks like Bank of America safe, dull utilities. The inconvenience was the endless lines at the branch counter waiting for your local manager's signature, or as my kids would like to say, banking was hard mode.
Yeah, and that brings us essentially to era three, what we call the moat of ubiquitous convenience. Over the past 45 years, from the 1980s to today, the great moat was built by incumbent banks like Citigroup, who spent billions in proprietary IT system spend. That moat has been destroyed essentially by technology platforms and regulatory openness. Starting with cloud services from providers like Amazon Web Services, and then mobile OSs, which have blown open the 500 million barrier to entry that access to tech was and has since vanished. Post-crises, global banks were forced to retreat, and we continue to see that. We'll talk about that a bit. And regional winners like, Banco Santander in Europe, or DBS in Asia, HDFC in India, and of course, all the Chinese majors really got a chance to focus on efficiency. Now, the new moat is being built by fintech giants like neobank and agile regulators via open banking. Finance is no longer a destination. It's an invisible intelligence that is essentially the new.
Nice one, Aman. Now that was Sigma. What strikes me is how the phases of each of these eras keep accelerating. It's both exciting and terrifying.